What's up, everybody? Chris over here, head trader, founder at Pollinate Trading. I am joined today with my good friend, Seth Golden. Seth runs Finom Group. And if you've been in the game for a while, particularly around 2017, 2018, he has an interesting story that is actually not a story that everybody, at least I thought, was the case. And we'll get into that. Welcome, Seth.
Okay. 2017, 2018, man, well, here we are in 2022. So, it's 5 years, but with COVID and everything, it feels like 10. It seems like so long ago. 2018 was Volmageddon in February. And after COVID, that Volmageddon event day that got so much attention. I'll do that 3 times a year instead of COVID,
Yeah.
But that's, it was back in 2017. I've bbeen an investor forever and a day. I started my investing life, if you will, career. But it's a lifestyle. If you're a trader and investor, it's a lifestyle. And I started in 1999, just before the dot-com bubble bursted. But, thankfully I was a newbie back then, because if I wasn't, I probably would have gotten wrapped up in a lot of that nonsense. But all I did was, I had my Scottrade account. Chris, you probably, come on, those days, right?
I started April 1999.
There you go. So we had our Scottrade account, and it was just a matter of, and you had spreadsheets, like you had to write down the opening price, the volume, maybe midday, and you had all these columns and whatnot, trying to figure out patterns. And the only thing I was trading back then, 2 stocks, Starbucks and Nextel. And I was working and just kind of, going through the motions, but I had some money. I figured I'd open up the Scottrade and see what I can do, because the market's always interested me, and wanted to grow my money. And in 2000, I started trading more frequently. And again, it was just Starbucks and Nextel. Dating myself like there's no tomorrow, push to talk, right? And that was the technology. That was the huge technology.
Yeah.
So I was just trying to make $100 a day. That was my goal. Make $100 a day. I got my day job anyway, and I'm happy. So I wasn't getting involved with all the, what we would call meme stocks now, right?
Yeah.
I wasn't getting involved. I knew Starbucks, and I had a Nextel. Like, I was just trading what I knew and trying to figure out patterns. And that lasted for a while. I kept doing that through 2002, 2003. And this is where you start, newbie traders, you're just trying to make a buck or two. You're leaving a lot of money on the table. You don't know generally the risk you're taking. You just know enough to figure out some patterns and, maybe make a few dollars. But as you, get older and want to do more, want to do better, because you got CNBC telling you, and showing you that there's more, and kind of graduate levels. Start as a day trader, start thinking about swing trades, holding for more duration. And I would say by 2003, I was more of a swing trader. It wasn't until maybe 2005 that I read my first 10K filing from, corporate quarterly earnings. And I didn't know what, I didn't know what to look for. But I guess how I developed as an investor and trader was just a lot of practice, a lot of failure, a lot of success along the way, but just sticking with it. I think you had a great tweet either today or yesterday. Something about the only traders that lose are the ones that give up, or something like that. It was really poignant, because that's what you find. 80%. I didn't know this, but I read everything and anything that's out there. And I do a lot of research. You've seen the Finom Group research reports. And I'm looking for tidbits. I'm looking for details. I came across this study from the New York University. It goes all the way back to 1999. And basically what they found is that 80% of traders will trade themselves out of the market in one way, shape, or form within their first 2 years. And I'm, by 2005, I was still doing this. I felt successful. But I, just like anybody else, you want to earn more. If you want to be a prop trader and a professional investor, you got to broaden your horizons. You got to start learning about 10Ks, fundamentals, technicals, quant, nowadays programming and software to automate your, trading and take your emotions out of it. Something that I preach all the time to new traders, experienced and professional, like hedge fund managers, is if it was just about IQ, everybody would read the same books, we'd read the same reports, and we have the same track record. But it's not, it's intestinal fortitude, it's stomach. Peter Lynch, said it best. It's not about IQ, it's about, can you stomach this? And I think this year is a really good example of, can you stomach this? But I went to work for Target. I was working for Target by 2003, while day trading and swing trading and working my way up that corporate ladder. It was, Target was a great organization. They nurtured me because I didn't have the best behavior, but I had great work. My finished product was great. How I got there and interacted with my team members and stuff left a lot to be desired, as they would say. Seth, here's your wins, and it's all work related. Here's your opportunities, and it's all people skills. So they knew that they could get a lot from me. It's just a matter of tolerating me at the time. And I'd walk around store when we'd have district folks come to our store and whatnot, and slowly working my way from just a replenishment executive, lower level management, to upper level management within the store structure, if you will. And after good 8-9 years, it's retail. It's a lot of hours. It's customers that, I'm going to have a bad customer comment about me at least once a week, and you're doing heavy holiday hours and stuff, and you just get burnt out, and I really had a passion for the markets, had a passion for economics as well. And so I put in for an internship with Goldman Sachs, and I got it. And I was doing junior research analyst work for the senior sell side analyst of hardware, information technology, if you will. So this is like 2010 when I left, 2011. And back then, because I had mentioned Nextel, so this kind of brings it full circle, Chris. Research in motion, right? Mm-hmm. BlackBerry now, but back then, research in motion, which was the dominant force in smartphones, or as smart as they were back then. And the senior analyst was like, he was on his way out, telling me, if you want to get a leg up, this is probably a good idea. What you should do is take on this quarter's work for, our sell side division in the hardware space, and, turn it in, and, because I'm on my way out and they're going to need somebody to replace me. I'm thinking, oh my God, this is it, Yeah. And man, you go all over the world to try and get all the information. You go to Waterloo, Canada, headquarters, you talk with management. You got supply lines in China, in South Korea, and it's a good 6 months worth of work. You've got your report. I mean, you think you've got all your I's dotted, T's crossed, and you turn it in. It's got your rating on it, which, I mean, based on everything that I had researched, which you have to research the competition too. So you're looking at Lenovo, you've got to, look at all the other smartphone makers, and it is a sell. It was a sell. And my price target I put on there, $42 a share. And this is where things go bad,
Yeah.
So, and I didn't know it at the time. I didn't know. Maybe I should have. I should have thought of it. I thought it was just about the work, and if you got the call and you've done all this and you stand by it, it'll be acceptable. You get called into the office, the big boy office, and literally sit down and literally had the papers, my daughter's drawing, had it thrown across the desk in my face.
Wow.
Pack up, get out. Pack up, get out. And there's not much you can do about that. So I had some friends also, coming from New York. They had worked for JP Morgan. They had a good client book, but I mean, you can only do so much, and there's only so much freedom working for a big institution. And they wanted to start their own firm. You start from the bottom, work your way, start as a small research boutique firm catering to institutions and hedge funds, selling whether it's macro research or stock specific sell side analytics. And so we started our own little firm. But by the end of the first year, it was like, because you do a lot of marketing expenses and everything like that, and we may have had like 2 to 3 decent clients, but it wasn't enough to grow. And the phones don't ring when you're this small working out of Miami. That's not what they think of as the hub of Wall Street analysis. So we were running low on funds, and this was early 2011. Maybe three clients, and almost a year removed from Research in Motion. And I bring that up because one of the partners comes to me and says, "You still think that this is going down?" And I said, "Well, it hasn't gone anywhere in the last 6 months. Literally has gone nowhere. It's been in the $60 range for the last 6 months and has done nothing. And everything that I've seen out of Apple and all of these supposed upgrades coming on the OS system from Research in Motion look like garbage." Because I bought, I think it was the Scorch, was their like upgraded first real smartphone with a slide out case. And I was like, it's just awful. So I was like, yeah, I mean, I think it's $42 easy. I don't think it should even have stayed up here this long. He's like, "What do you think if we bet on black?" He said. That was his exact word. He said, "What if you think we bet on black?" It's like, "What do you mean?" He's like, "What if we short it? I mean, we've got about X amount of dollars, and unless you want to put more in for, we've got to reinvest our own capital. This might be a good way." I was like, "All right, Frank, if our other partner's on board, let's do it." And so we did. We shorted Research in Motion stock options. Maybe 2 weeks later, I'm driving home on 95, or maybe it was the Sawgrass in Florida here. I'm driving home and the phone rings. I pick it up and it's my partner. He's like, "Do you see what's going on after hours?" I was like, "No, wait." And I saw, and Research in Motion was down $5 after releasing earnings. I was like, okay, but this is like a month later. We've eaten up a lot of theta in the meantime in our options. It's like, all right, we got a lot more room to go to the downside. Within the next 4 months, it had broken below 55. By the end of the year, it hit our price target, $42. And I wanted to pull out because, I mean, it was huge. It was a huge win. And he said, everything technically, my partner does all the technicals, and he's like, everything technically says $28. It's like, all right, we can ride half. We need to pull at least half out after this. And we rode that last half down to probably $12 a share and basically supported, all of our, cost and whatnot for a good 2 years just off of that. But to bring volatility and, the whole thing back to center, we had one client who brought us this S1, the prospectus for ProShares UVXY. This is in 2011, 2012. And I don't know what volatility is from anything. I just know how to pick stocks. I know what the market's going to do over time. And as long as I have time, I'll be fine. So he asked me, read the prospectus. This sounds like an awesome product. I'd like to know more, but we pay you, so go to work. And I'm like, okay. So I read it, and it's like Greek. Yeah, I mean, reading a prospectus on inverse leveraged ETFs, like, could it be any more obscure at that time?
Right. Yeah.
Nowadays, it's like inverse ETF, my child can write a book report on it.
Sure.
So I read it, and I'm like, okay, this is going to take a little bit longer. I finally think I've got it, and I tried trading UVXY. And it says in the prospectus, you're not really supposed to hold these things for anything more than a day or so. It doesn't outright say that, but it's implied in the verbiage. And I'm losing. I'm just every day. It's like, why the heck it just goes down? The market's down. It doesn't matter. This goes down. The market's up. This goes down that much more. What am I missing here? So I have to do that much more work, resourcing and things of that nature. And I learn about all the different facets of implied volatility, realized volatility, term structure, VIX futures, and all the derivatives of that complex, to where I finally understand, as long as I do have time on my side, whether it's through position sizing or duration, this thing's going down long term. All I've got to do is maintain my liquidity. And so that's what, from 2012 to 2017, it was like a piggy bank. I mean, you couldn't do anything wrong. I mean, you take profits here and there because you got to call them and whatnot. But every spike in volatility, you're just, pounding it with another, short order of consequences, and layering in if it doesn't work out right away. And it was just a gold mine. And by 2017, and doing this for a good 5-6 years, and doing, it was very lucrative. It became my primary strategy when it came to the portfolio. In 2017, I get an email, and just like any, it looked like spam. It just, Wall Street Journal. So I thought it was a subscriptions, solicitation. And I, put it into the junk bin. A couple days later, same thing, but it has something different was underneath that I could see in the subject. So I opened it, and it was a New York Times reporter. This is like July maybe of 2017. And he wanted to talk to me about, he had seen a YouTube video and he wanted to talk to me. So picked up the phone, called them. And for like the next 3 weeks or so, well, most of what I rehashed here is what I, discussed with him. But he was enamored with, this is just a Johnny come lately who worked at Target, turned into a, multimillionaire by shorting volatility. And, still I go every day to pick up my daughter from school, and that's like the best part of my day. And so everything else about my, research and strategy and my firm and whatnot got completely left out of this New York Times article when it was published. And it made it look like I had literally just left Target like last week, and just started trading. And because volatility has been such an easy short in 2017, because the biggest correction in 2017 was 3%.
Right.
And volatility just, imploded to the downside. That was the angle the New York Times article took. And lo and behold, 2018 comes around, and it's like, it was the exact opposite market environment from 2017. So I got a lot of hate,
Sure.
in social media, and zero hedge art. Like when you appear in zero hedge articles, you've actually made it, right? It's actually a badge of honor.
Right. Right.
But yeah, unfortunately, the story that the New York Times published, while factual, it omitted a great amount of, my investing career and, how I actually, got to where I was at that time and, where I am today with Finom Group. So that's the long story there.
That's a great story.
Thank you. I mean, if I had known better, right? Because that was my first experience with the press, I probably would have been a little bit more reserved and, said things maybe a little bit differently and whatnot, or just not expose certain areas of my background. But that was it is what it is.
Right. Because the implication is that nobody who, if you don't have a Goldman a Goldman job and Ivy League education, you shouldn't have access to the same Google that everybody else has to research and learn about the markets, right?
Yeah, exactly. I mean, if I listen to, and don't get me wrong, I still have third-party institutional research, and I actually tweet out a lot of times for the public. But if I, whether it's JP Morgan, Goldman Sachs, Bank of America, Fundstrat, you name it, for the most part, your number one asset as an investor is time. The market's going to do one thing over time. As long as you position yourself on that track, you'll be fine. I think a lot of traders and investors, hedge fund clients of mine over the years, they make things extremely complicated on themselves, trying to be stock pickers and trying to be contrarian. Like, why do you want to be contrarian of up and profitable? Like, what are you doing?
Right.
But yeah, I mean, I've learned over the last, 1999 to 2022. That's the one thing that, is a constant. Market will go up over time. Work with it. Don't work against it. Make it as simple as you can, and educate yourself. There's, man, so much out there that is nonsense, or even if it's good. I mean, you can find some good stuff out there, but is it practical? Like, what does it give you an edge? Like, if it doesn't, you're liking it, you're retweeting it, you're really just wasting your time. And that's kind of, I see a lot of that in social media. It's just, there's a lot of good charts and stuff and statistics, but if it has no practicality for your portfolio, for your risk tolerance, you're wasting a lot of time at where you can, probably spend that doing better, more practical and user-friendly research. So.
Yeah. User-friendly research. One thing I always say is that so much of the stuff that's shared and people, LARPing, live action role playing as a fund manager, you're managing the $25,000 401k or IRA, right?
Yeah.
Or whatever it is. And you're, like trying to play the game of, how short should we be on euro dollars right now, right? The reason that people are in the big money is in those places is because that's the only place that they can participate with as much money as they have. But, the average person, and by average, I mean, up to probably $1 billion of AUM from $1,000. There's a lot that you don't have to play that game over there, and you can pick up all these other things. You do a great job of keeping everybody in that mindset of be long and play the long-term trade. I always love getting some of your followers will quote you, retweet, or not quote you, not retweet you. They'll quote you in response to something I put out there, and it's always of that same nature. So. For me, there's two really big edges. The upward direction of equity indices,
Right.
So as long as you're in the, that doesn't mean that you're, you can't be a stock picker too.
Right.
But if, the biggest index in the world is kicking out all the bad crap and only putting in the good crap, they're already doing the optimization you don't need to be doing.
Yes.
So you don't need 10Ks. Let that huge firm do it for you.
Yeah.
And then position sizing, your risk management. Just don't let let's say we're at a 20%, about a 20% drawdown. I think we had here in 2022, give or take, on the major indices. If you can't suffer a 20% drawdown, then without getting margin called or puking, your position sizing's off. You're definitely you're going to be out of the game. You're going to get taken out of the game. And both of us have been in for 23 years, and I'm sure you and I both could come up with probably 20, 30, 50, 100 of the research in motion type trades that you just nailed, right? And I could probably come up with maybe a similar amount.
Left a lot of money on the table with Peloton, but I nailed it.
But at the other end of that is I could probably not even remember the 10,000 other times that I was not as, it wasn't the trade of the century. It was just kind of I don't know, I made a couple bucks, or I got stopped out on a couple bucks or whatever. The name of the game is to stay in. And
got the base hits.
Yeah, got to get the base hits, got to be in the game when you got to luck yourself into it. I think is one of the things. There's so many things that we don't know, and sometimes you're like, oh, this is the right place to be. Okay, and then everybody's positioned short into the world ending, and then the surprise election happens, and you get like a 2-year run that's just like, wow.
I'm okay with being lucky in 2020 and getting all that stimulus and getting all fiscal I'm okay with being lucky in part. I'm great if it's a matter of being good also, but I'm not going to begrudge myself or anybody else for falling into some lucky years, lucky complex, lucky area of the market. Those folks with the GameStop and the AMCs, like good. Yeah, good for you. At the same time, it's not what you make, it's what you keep.
Yep.
I think that's where we are. That's 2022. A lot of folks did, like you said, a couple strong years. I mean, it's rare that we go up double digits 3 years in a row.
That's crazy.
I mean, come on, 4
and
years?
and big double digits.
Yeah. It wasn't like 10%, then 11 or 3. I mean, we're 20s, folks. And so when people complain about 2022, I'm like, really? Did you not lock it in? Did you not rebalance? Can we talk about discipline here?
Right. Yeah.
So but I those folks that got that first stimulus check, opened up their Robinhood account, and then took GameStop and AMC and even Bed Bath and Beyond for a couple of rides that I participated in on the other side of the trade. Great. But now you got to keep it. So
yeah. Well, and just like any time, like you and I both started at the .com bubble, and it always is that way. You have the new thing. Back then, anybody who'd been in the market longer than maybe 5 years or so, they were all yelling at us because of the internet. You internet NASDAQ tech traders, you guys are scourge of the.
It was Gen Xers,
the scourge of the market. And it's the same people who are getting yelled at. Yeah. Same people were getting yelled at in the 80s for trading equities and in the 70s for trading commodities. And, it's just cyclical. I agree. Just a fun way to kick it off. And like you tell that story very well. It's the first time when I kind of put it together, I was like, I remember them saying it was the Target guy. They never once mentioned this guy also worked at Goldman and had been doing it for nearly 20 years already. And was at a research firm market research firm already. So it was just that. And so, but funny. So you've obviously got the cred to back up your opinions on the markets. And right now, let me just paint the picture. We're going into a Fed meeting. They're in the meeting today. They announced tomorrow. They've been, we've got just lightning fast inflation for, gosh, what a surprising reason. And the world's been in a bit of chaos. Like I said, we're down probably about 15% right now on the year, which is something that people haven't seen in a number of years, and for such a prolonged period. I mean,
right.
We're almost 5 months into this thing. My goodness, like, can the world survive a five month pullback? Is this thing going to end? So what do you got going on with the market? Like, what are your views right now of, like, okay, I just said where we were. What scenarios do you see going forward?
Coming into this year, and I'm always preaching, think ahead, think ahead, think ahead, think of the market's next move, consider the market's next move. So coming into this year, like, I used the fourth quarter of last year to rebalance, lock in profits, raise cash. Because, like you were explaining, cyclicality, it's the next cycle. It's the next cycle. And this is year 2 of a presidential cycle, and it's a midterm year, which are typically the absolute worst years for the market. That combination there, year 2 and a midterm year, worst year for the market of a 4-year presidential cycle. I mean, this goes all the way back to 1950. And if history rhymes, right? 2018 was another midterm year. Like, look at all that volatility. But you also knew that inflation was running hot, which the market does okay in an inflationary environment to a certain point. And at some point, if that gets ahead of the Fed, then the Fed is going to have to do something in the way of tightening. Unfortunately, they can't do anything about supply, but they can do a whole heck of a lot about demand to try and bring things into a balance. So coming into this year, I actually thought we would get somewhere on the magnitude of a 10 to 15% correction. Didn't know when, didn't know how it would manifest exactly. I don't think anybody does, but this was kind of my expectation. You came from a lower volatility regime last year, and typically the next year you see a higher volatility regime, and that's what we've gotten. So it's all playing out actually rather normal and to be expected. And I preached that for, a good portion of this year already, normal and to be expected. Unfortunately, I can't lay that down anymore, because when you've had the worst start to a calendar year in the NASDAQ's history, it's hard to say it's to be expected. Yeah. The worst is the first time, and that kind of goes out the window, So from this point going forward, it's really been about enduring. You had mentioned before, you can't take a 20% drawdown in your portfolio. Something's wrong with your process, basically. Either you're not rebalancing, your position sizes are too small, maybe you're trying to hit home runs instead of settling for singles and doubles, and every now and then you get the triple, putting yourself in a good position when you come to the plate as an investor, using our baseball analogy here. But yeah, what I think the environment that we're going to be in is rather unprecedented at this point. I have some analogs that, are working so far. 1982 is a really, whether you look at the fundamentals or the technicals in the 1982 S&P 500, up until April, we were like on it like a pancake. And the fundamentals are eerily similar too. They're both decennial years, both midterm years, just coming out of a recession in 1982. The last time inflation was 8% or higher was 1982. This is obscure, but man, history just kind of repeats, or at least rhymes. The Bengals, the last time they were in the Super Bowl was 1982. And they lost then, they lost this time. But all kidding aside, I do think this is a little bit more unprecedented. So I'm relying less on the models, trying to be flexible and open-minded, because I think, all anybody's hearing is how it's an impossibility for the Fed to get a soft landing in this environment without knowing, how this whole inflationary regime is going to culminate. And when the supply lines are going to be, repaired to one degree or another that facilitates a disinflationary environment. So I think, the best approach for any investor in this environment is to be flexible, lean on your resources. Like if you don't, this is the time to have those resources. And if you don't feel comfortable with the resources you have, reach out. There are plenty out there. It's just about, doing the work. So the Fed's going to hike tomorrow, 50 basis points. It's pretty much etched in stone. A lot of folks don't know that this is never guesswork when it comes to the Fed. Keeping in mind that as the repo market has a dependency, and I don't want to get too in the weeds here, but the repo market has a dependency on Fed fund futures. And if that's out of whack, the whole system's out of whack, and we're going to have issues in the credit markets. So I use the CME Fed Watch tool. It's called CMEFedWatchTool.com, and that basically gives you, the Fed fund futures market. And whatever it says, are they, they're betting on the May contract because we're going into the May Fed meeting. If that says that the probability of a 50 basis point hike is 60% or better, the probability is 60% or better, since the CME Fed Watch tool has been created, it has never been wrong. So whatever that says, as long as the probability is 60% or better, that is exactly what the Fed has done at the FOMC meeting. And right now it says 50 basis point rate hike. So that's what they're going to do. Come the June meeting, right now, it has a probability of 86% that they're going to raise 75 basis points. Now, we still have 6 weeks between now and then, and we're going to have another CPI and PPI reading, so things can change. But again, these are the tools, the resources, so investors aren't necessarily wondering, because in social media, you see, well, what if they, stop with what ifs. There are tools that tell you what they're going to do. You don't need to be anxious. This is what's going to happen. It's never been wrong. And until it is, you lean into that probability of 100%. So when it comes to the market, I've been saying this more recently, given that we're in this derating cycle where the valuation of the S&P 500 came into the year at 21 and we are at 18.5. I mean, that's a massive derating, while earnings are still going higher, and we're having a pretty darn good earnings season. So for me, it feels like you're getting this adjustment to the equity risk premium. Bond yields are going higher, so there's competition. You don't have the TINA trade anymore with the 10-year yield at 3%. People can go elsewhere. So you devalue the market. But the market also wants to be confident that the Fed can manage this process without, as we hear in the media every day, crashing the economy or putting us into a recession. Sorry for my hyperbole. Putting us into a recession. The market, I think, will feel that much more confident about the Fed's ability to arrest the inflation and manage us through this and possibly into a soft landing, i.e. 1994, if we see the CPI crest and roll over. Until we see that happen, the market is still, in my opinion, left in this state of flux of not having the ultimate confidence that the Fed can do this. The Fed needs help, and the help would come from CPI rolling over and, and continuing on that path through the end of this year. So I think we're still going to be in this chop. We're going to be in this high volatility pressure cooker, if you will, with probabilities to the downside near term, unless we, do see that CPI on a month over month flatten and then roll over. That will give the market more confidence. So I think that's just, the environment that we're in. And typically midterm years, the average trough for the S&P 500 in a midterm year is September. So while, we still are making lower lows, and we got a gap in the S&P 500 at 4020, came close the other day before that, really nice outside reversal. Like, that's still out there, and the markets love, to revisit the scene of the crime. So it's in close proximity. It wouldn't surprise me if we filled that any more than it would surprise me if we went back to 4,600, quite frankly. I look at the technicals. I look at the fundamentals. I'm a fundamentals first kind of guy, but I've learned over the last 5 years, again, just kind of the evolution of a trader and investor. You got to want it. You have to want that education, and you have to want to be multifaceted and not be pegged as the target manager. But I've learned, technical analysis over the last 5 years has taught me a great deal. So, I try to pair those. And I'm just coming into quantitative analysis over the last 2 years. I think I've got like 2 years of quantitative, education under my belt. And I'm just finding, man, I'm 45 years old now, and the market's 23 years. And I don't think I'll ever be able to say, I got this.
Right.
Got it, So.
Yeah. The quant stuff, which is pretty much where I spend my life, is the fun thing about the quant stuff is it's the most boring thing in the world. And so you have to kind of like, I don't know, make stuff up to like entertain what's going on in the market.
Right.
It's just like, oh, there's like a 72% chance that this is going to play out at this level.
Cut and dry, and
all right. So what do I do for the next 23 hours and 59 minutes?
And that trade's on. So what else do we got here?
Yeah. It's a lot of fun. I love the quant world. A lot of fun. You can definitely go down rabbit holes as deep as you want, just like you can in any form of research. But it's wonderful. Speaking about your midterm year, I did a lot of quant work myself on the midterm year, and of an incumbent first term, I should say, president midterm year, and I did it on all of them too. But I think it was only 1 or 2 years where it was the outcome was actually bullish out of 50. I forget how many times I did the analysis, and exactly August, September, October, right around there. If you overlay your chart on it, and you just see it goes up and then it goes down, and then it kind of starts rallying, and then as soon as this is the qualitative side of it, as soon as the politics seem to have been worked out, so that that let's say so it's a Democratic executive branch, and once you can confirm that you have gridlock in DC, so that Democrats are going to lose the House and the Senate or whatever it is, once that's there, everybody's like, okay, they're not going to throw any crazy new things at us. It's going to be Hail Marys, but nothing's going to go through. So once that part's kind of like figured out, it goes. It also happens on presidential years too, in that sense, but it's so much predictable in the midterm, first term, part of it. And so like, they
love gridlock. They love when that tape is so thick, nothing gets done.
Yeah. Cause you can actually place bets and know that the bets are not going to be interfered with. They're not going to raise taxes, corporate taxes, or
can we go back to that? Because man, if that was the worst thing coming into this year, right? Remember when it was, well, they're going to raise taxes in 2022, and everybody's doing all this analysis on when they raise taxes, and and markets actually still go higher. I mean, who's raising taxes into a bad economy?
Yeah.
But man, that was like the worst thing that we were supposed to contend with this year, and so much for that.
They're trying to jam as much as they can through right now, it seems like, or they were trying to, but yeah, it's never so far this year hasn't been a surprise, I guess I should say, even though we're not,
policy front. Yeah.
Well, and returns on index, right? It's, as you were saying, the 82 analog
playing out. I mean, the trough, the average midterm year has a 17% drawdown since 1945. The average midterm year is and so from that perspective, if we're just talking about the S&P, we're clearly not talking about our NASDAQ friend. But from that perspective, and despite, you can throw all the different circumstances you want, the Fed this, gridlock in Washington that, supply line, like you're making it, in my opinion, people make it complicated. It's a midterm year. The market goes as fund flows determine. And in midterm years, the fund flows just aren't there. We haven't had the fund flows here this year. We've had a ton of outflows.
So let's say you're the average investor. They really, and there's so many people I started a newsletter business. I started, my community after leaving macro ops in 2020. So it was kind of like when the Fed sent money to people, they were like, we're in the market, and booms. And I've also noticed a lot of the people that have been with me have gotten into a position where they're taking a lot of breaks. A lot of people that have been interacting with me on Twitter over the last few years, they're just not there. It's a different crowd. There's, it's a lot of people have mispriced their investments or nothing more confident than I don't know what the term is, but let's say, when you're in a bull market, you're pretty good. Things are pretty good. And, especially, a March 23 bottom call by my buddy Seth of 2020.
Every now and then I get lucky.
He beat me by about 2 weeks. And then even then I was just kind of like, well, it looks like it wants to go up, so I'm gonna just go with it and let it go. And it ran.
You can be within 10%.
Uh-oh. We had a bit of there we are. Okay.
Yeah. My internet probably unstable there. No, I was saying, if you can be within 10% of a bottom, you're doing fine. You're doing good stuff, Yeah, catch the absolute.
Totally. Everybody wants to bottom tick. Everybody wants to bottom tick. Sometimes you're lucky enough to nail it or skilled enough. For me, I just want to be lucky enough to realize that, 20% of the time, 80% of the time, a market is going to be mean reverting sideways. 20% of the time it's going to break out. And that 20% of the time is going to go further and last longer than anybody expects. And that's an easy game. You just wait for it to go. And there's no reason for me to sell. It's, it's still moving. But, 23 years to figure that out, I suppose. When, but in an environment without stimulus checks, let's say, first of all, somebody's coming into this new, or they're dealing with their first major drawdown over, their trading career. And to be honest, I don't know how you feel, but these are always times that I remember a little bit more than the good times. I don't seek these out, but I know they're there, and it's there. What do you think that people should be focusing on? Where's the opportunity right now? What advice would you give people?
Well, if you're newer to the market, you're taking this drawdown, which, look, you don't have to be new to take a draw. Everybody's taking a drawdown on some level, or at some time. Then, in my opinion, the number one thing is to not walk away, endure it. There's an educational value to extrapolate from all markets of environments And you get to know who you are as a trader and investor in these, really difficult, volatile periods. So, my recommendation, that was closing bell there, to any investor is to stick with it. Hone your game plan. One of the exercises I did just this past weekend was, look, we're down 22% in the NASDAQ. Like, I'm growth levered. I'm generally in the growth areas of the market, whether it's a leveraged ETF, for the growth index, the NASDAQ, the Qs, the NASDAQ 100. I'm generally in that area of the market. So I'm taking a bigger drawdown on a year-to-date basis than somebody who's just in the S&P 500 or the Dow. And so what I did this weekend is I said, okay, the market, the NASDAQ is down 22%. What if, right? Because what if this is mean reverting from a .com-like situation, up significantly 3 years in a row, and markets do, market is symmetric. It likes to mean revert. What if that happens and now we're down 45%? Where's my portfolio? In conjunction with my already, crafted game plan, where I'm levering in, I'm buying dips in layers as the market is going down. Because I got the cash, like, that's solid. Like, I prepared for this late last year. But if we're down 40%, 45% in the NASDAQ, if we are in a real bad bear market scenario, where's my portfolio, and how much do I have? How much cash do I have if we're down that much? So I ran those exercises, and because I wanted to see, would I be comfortable, basically wiping out, regardless of the preparation, you're still wiping out a significant part of last year's gains. Would I be comfortable, and how much cash would I have on the sidelines? If the answer is yes, I'm comfortable, then I'm okay. At least I know I've done the homework. I've set my, emotional quotient on a stable foundation. Like I said before, it's not your IQ. Most investors, they don't test their intestinal fortitude. They don't know if they have the stomach for it because they don't go through the exercises, or like a lot of folks do, they just, the market did this to me. I'm done with it. I'm going back to my 9 to 5. Yeah. And I'm just done. The Fed did it to me. The market did it to me. Market doesn't care about you enough to do anything to you.
Yeah.
So yeah, I mean, during the March 2020, crash, I remember being in the trading room with our members and saying, don't look away. Do not look away from this. We'll get to the other side. Those who don't look away and extrapolate that educational value, we're going to get to the other side together. You just got to endure. That's it. A lot of folks will do all these, and don't get me wrong, hedging works for a lot of sophisticated investors. But for the mass majority, it's just too complicated. And if you haven't, like, if your emotional quotient isn't steady, you're not going to feel any more confident about opening that hedge and managing that new position in a less stable state. Like, people hedge out of fear, not rationalizing it's another position that you're going to manage in this state of fear. Like, sometimes there's a lack of logic that people use when they're hedging. I do recommend it for those who are experienced and can educate others on the best hedging strategies that don't demand that much more due diligence, so far as managing the hedge and having to time the entry, the exit, the premiums. So, there's hedging that they can do, but really the best thing is, to ride it out, have a game plan where, like, what's going to happen. Ultimately, what's going to happen. The market's going to find its low. It's going to, if it is one of those situations where we're down 40%, don't get me wrong, I think that's a very low probability, but, running the probabilities, if it is, trust that the market will have sent the Fed and the federal government a message. and as I've always said, the market dictates policy. When the market speaks loud enough, policy starts to shift. In 2018, that December rate hike and that autopilot verbiage from the federal chairman sent the S&P 500 down through Christmas Eve. I call it the Christmas Eve massacre, because you thought at Christmas Eve, at the very least, deliver us,
don't go down 5%.
Yeah, we hit the lows. And but that was it. That's what it took. It took the market sending a very disgruntled message, to the hierarchy, and all of a sudden we rolled into 20, and the Fed was on pause. And then by later that year, they started to reduce the federal funds rate. So what's going to happen one way or another. You're going to find a bottom, just have enough cash and a lot of people, I get this sometimes because, I have allocations into the fund every year, the portfolio that I manage. And people will say, well, that's cheating. I only have this, and this is what I start with at the beginning of the year, and that's all I'm using. It's cheating if you add to your portfolio. I'm like, don't you add to your 401k every year? This is just a more actively managed and who am I cheating? I didn't realize I was in competition with somebody that I could run afoul, with social media, it's like we get into these false paradigms that really don't exist. It's not capital competition, it's capital appreciation. And, just with social media, people forget, what they're doing and get wrapped up into these nonsensical conversations and exercises. So endure, cash on the sidelines, build that intestinal fortitude.
So let's test that intestinal fortitude a little bit.
Okay.
We've got some headline risk ahead of us.
Yeah.
One of the biggest ones, we've got a couple of these put together, but World War III. There's a war in Ukraine, Russia, and Russia invaded Ukraine, and Mr. Putin is going under the knife, I think, today or so, for cancer surgery, 2 months after starting invading a country, doing a special operations or whatever.
Hell of a guy, isn't he?
Lost himself a good 20 generals. I personally, being a military man, do not know, and definitely a lover of history. I can't recall it because I've never actually put these keys together on the Google machine to tell me when was the last time a U.S. general died in combat. Like, I don't know. I don't know.
That's we tend not to think in those terms because it's been so long.
Yeah, I couldn't even fathom. I mean, I know they took MacArthur off of was it the Philippines or somewhere because they thought it was pretty close that he was going to get taken out. And if that was the case, that would have been a big blow in World War II. But 20 generals have died on the Russian side in 2 months. That's wild. So, scenarios there, because the World War capital or World War Super Bowl, host of the world is Europe. They always put on a good show when it comes to wars. What do you think about that going forward? What are your thoughts of where we could go from there?
I did a video when, basically a couple days after the invasion, so late February, first week of March. And this is all opinionated. I'm not a military, man. But appreciate everybody's service. My thesis, if you will, was that at some point, I'm a faith-driven person. I'm a Christian. I do youth ministry. We are living as a global community. We are living under the threat of this guy possibly hitting the button. And I ask myself, is that living? Right? If you're essentially you're captive in some way, shape, or form. You're captive because of the threat coming from this one individual. So I get it. You know, I totally understand. Nobody wants to kick off a nuclear war. I'm conflicted. I guess that's what I should say. I'm conflicted because I don't have an appreciation for living in this captive state. I don't. And maybe it's just I'm not disciplined enough or what have you. You know, forgive me for that, but I don't. So I could see the argument for, and I've said this before too, like we really can't get in touch. We really can't negotiate with these oligarchs, you know, in the inner sanctum of the Putin security regime and pay these guys off and say, just a little bit to the left here. And, you know, I mean, I've seen Sniper. I know it can work. You know, I'm just conflicted in that sense. I don't foresee a World War III taking place because we're so politically correct, not just here domestically, but around the world. So politically correct, so living in that state of fear of the potential of nuclear war that, you know, we'll do everything possible to exhaust that option. And that's, you know, the kind of the track that we're on. I think it's horrible that we're substituting money, you know, as a means. We're watching people die, you know, every day on any news work. You're watching these people die. And yet we're able to live here and feel comforted, but we're sending aid. We're sending aid. Imagine if that was on our doorstep. Would we feel like sending aid is the number one option that our partners should be allocating? You know, no. But that's where the world is at so far as diplomacy, till diplomacy has run its course. And we just haven't found, you know, that terminal point where we think as a nation, European, you know, the European Union as well as North America and NATO, we haven't found that point where we've said diplomacy has run its course. We now have to take a different military action. I hope it doesn't get to that point. I hope that we can actually exhaust, and it's not 20 generals, but we have, you know, enough to where, you know, they retreat or at least feel that it's no longer in their best interest and can rid ourselves of this, you know, European war. I just don't know how you get Putin to come to that realization, you know, at his age and based on, he's lived his life for this purpose, which is to bring back, you know, the USSR, if you will. I don't think that you can embed the mindset that there is a set of circumstances where he'll be found retreating. So it will just be overcoming. I think, unfortunately, it's a matter of overcoming. It's a matter of a lot of people dying, a lot of prayer. If I relate it to the markets in the worst case scenario, you know, if it does get to that point where you do have NATO get involved, US directly get involved, Japan get involved, Australia getting involved, you know, with boots on the ground and missiles from the sea. Yeah, the markets are not, I mean, you'll have a global catastrophe, financial markets and everything. But you can't, as an investor, you can't invest with that as a premise, that as a what if, that as a risk measure, in my opinion. That's a pessimistic way of participating, and pessimists just don't get paid. The optimists do. Secondarily, if that comes to pass and you're investing and you have all this risk in the market, guess what? If the worst case scenario gets played out, there's nobody on the other side to collect that trade. We're all just going to find food and shelter. So, yeah, everybody's in the same situation. Nobody's picking up the phone saying you have a margin call. You know, if we're in a global world war and the financial markets and the global economy is falling asunder, nobody's giving you a margin call. Everybody at that point is just hunkering down once again.
Yeah. That's there's a lot of potential out there with the Ukraine, Russia situation that could
Sounds
go.
like they're doing, I mean, it sounds like they have done I don't want to say great job, because I mean, you have thousands of Ukrainians dead. So it seems kind of, wrong to say they've done a great job, but it doesn't seem like Russia's making the headway. We're almost 2 months into this, and they seemingly have been stalled at every, corner. They've done a lot of damage, blown up a lot of stuff, but much more than that. Where's their success? How do you measure any success based on what they've done so far?
Yeah, as you pointed out, Bretton Woods 2, I would argue Bretton Woods 3. Bretton Woods 2 being 1971, coming off the gold standard. We rogued the world like, hey, we're the reserve currency. We got gold. And then we're like, but we don't need it. You got us. What are you going to do? And then this last time, you had a good piece on that. It would be interesting to see how, a 20%, I mean, they're paying 20% on the ruble.
Yeah.
Like that's you got DeFi people in crypto who are like, I could go and get 20% on the ruble instead of my little farming operation over there. What is this world coming to?
You got to be feeling bad for the Russian people who are just in this, they don't know exactly why the situation, because they're not allowed to. But man, the suffering there's no way back for Russia. It has to be a Putin-less Russia. Otherwise, this is what Russia is for the foreseeable future. Because the world will not deal with this man as the leader, and therefore they're not going to deal with Russia. And Russia, therefore, all of its natural resources, all of its trade potential, has no potential with Putin. So, man, I mean, if nobody wins here, nobody wins.
Like other than, a flashback to when we first started trading in the axis of evil. I remember that.
Gosh, what was, so that was Saddam, Osama, nuclear, and North Korea.
Iran. And I don't know if Iraq was actually in there. It might have been, but it was Iran, North Korea, and it wasn't Russia, ironically. But that sort of situation is about the only way and that could really have some power shifts. But it's again, not again, but we're a $50 trillion economy. Levered. But where do you get where do you put your treasury? Where do you buy your treasuries? Where do you put your real estate? Where do you put your money? If you have enough of it, you can put it in China. That's fine. That's a fifth of the size or even smaller. But speaking of China, they have a no COVID policy lately. And I thought when Russia invaded Ukraine, they cured COVID right then. For some reason, it's still happening. Somehow a war didn't do it, but Twitter didn't really think that COVID was a thing anymore as soon as Russia happened. China has since changed that policy. We're going to have some supply chain issues. That's well known. We've ran that playbook before a few years ago, and we know where we came out the other side. We know now how to deal with COVID a little bit better, I think, after a couple of years of dealing with it. But China surprised everybody and just locked everybody down. We're talking 1 billion people country. Not they didn't lock down the entire country, but that's huge.
Biggest provinces, Shanghai.
What effects is that going to have if we get an A, B, or a C outcome from there? What is that going to start? Doing?
So rolling lockdowns, I guess we should think of them, because we're locked down for a good month. Shanghai, which is like the biggest or second biggest province there, and that is reopening now, thankfully. But they've started the mass testing in Beijing, which which is the next biggest hub there, and in population and everything. We don't know yet that they're going to follow the same game plan as they did in Shanghai, but if they stick to the no COVID policy, I guess we should assume that is the path, and so, yeah, you have this continuing issue with supply chains because you don't have, these are manufacturing centers as well. So you don't have them at full capacity. So we heard from the likes of Apple and a few other fab producers in the region during this earnings season saying, this is the kind of hit that we think we're going to take, not because the demand isn't there, but we can't get the materials, we can't get the supply, we can't get the finished goods. Therefore, we can't meet all the sales potential that otherwise would be there. So from that standpoint, again, and it's just all of the confluence of issues this year. That's why I said earlier, can we just go back to worrying about raising taxes? But I think the market is accepting, look, if they accept what Apple says, that's all that really matters. That's the most heavily weighted stock in the S&P 500 and NASDAQ. If the market can, accept what they've said, take the I think they said $4 to $8 billion hit on sales from Apple for the coming quarter, then it's a less of an issue. I don't put it past China. Look, China did all of this stuff to their technology sector. Alibaba is like the crown jewel of China, and they did what they did with the technology sector, which directly impacted that company and some other industries, for-profit education industries and things like that. It's a communist nation. Everything they do is pretty methodical and locked down, for lack of a better phrasing. It wouldn't put it past me. China's leadership has seen the damage that has, befallen the likes of Alibaba. It wouldn't surprise me if Alibaba came out with this fantastic quarter, because guess what? People couldn't go out to buy, but they had to buy online in the most populated cities in China. And now we're rolling it to Beijing. Let's make up for some of this lost revenue and whatnot, kind of patting the dog on its head, so to speak, and make everything all good. I've had that kind of conspiracy theory, but from a global perspective, and this is where the Fed comes in the picture too, and why I often make the argument, why does the Fed have to do anything? Why, inflation, look, let the consumer decide. If they said we can pay for it up to this point, let them pay for it. The Fed can't really, it takes a lot of undulation in the financial markets for the Fed to commit to the exercises of monetary tightening. And yet, none of that will change the supply side. You almost have to be of the opinion, and that's why it's the squeaky wheel, and in order to get inflation back to a normalized level, you have to cut demand. You have to impact demand so egregiously. And yet, you don't know how long this other side of the equation is going to be, in shambles or in a state of disrepair. You don't know when the supply side is going to catch up, when it's going to be repaired, reliable. Because right now, it doesn't even matter if you arrest the demand side. If you're a chip manufacturer, you've been ordering as much as possible because you just don't know. And you want to be as close to the front of the line when the supply's there as possible. So you're paying up for those materials, for that workmanship, for the labor, for everything. And you've gotten into this habit now for the last 2 years. You tell me that you've been doing that because you're untrusting. You're untrusting of the supply system. And now you throw the US economy into a recession. Now you can't trust the demand side equation. So That's why I say, why does the Fed have to do anything when it comes to it? Let the consumer work it out. Let the market clear, right? That's what we hear for the last 13 years of quantitative easing and just easy policy in general. Let the market clear. The Fed shouldn't get involved, right? That's kind of the perma-bear camp, the naysayers, the pundits. Yet you don't hear them say anything about the Fed getting involved with tightening, right? It's okay for them to be involved in this situation. Not okay for that. So, and that's, it becomes why people say the Fed is political, even though they're supposed to be apolitical. And I think that does the organization a disservice, because it is hard to argue. Why should the Fed do anything here if we know, and we've all pretty much come to this consensus, they can't solve the most important aspect of the equation presently. All they can do is hope to beat the crap out of the other side of the equation to give the supply side some time to heal. You know, we've got the bench players, you know, on the field while our starting lineup, the supply side, is healing, you know, and that's kind of the way I view it. But fortunately, we do have time. We do have time. China is doing, they're fixing their demand side, right? While we are just hoping the supply side comes back. Part of what they're doing with stimulus, lowering their reserve rates and everything, their RRR, is trying to facilitate the demand. So, you know, that adds liquidity in a sense to the global financial system, even though we can't really, you know, see it transparently other than, you know, through currency pairings and whatnot. But I think it's not, you said it perfectly. We have a $50 trillion economy leveraged. We've gone through COVID. We've gone through supply side issues over the last 18 months. You know, we got travel. We've had travel issues, service industry issues with the reopenings, then lockdowns, and then just the fears. We've gotten through the labor force issues, labor force participation issue. It's like we've thrown so much stuff at this, so much variables at this, you know, $50 trillion economy, and we haven't broken it. So the supply side issue and these rolling lockdowns in the no COVID policy that China has taken, I guess the best way to put it, it's not scalable. You know, it's an issue, it's a headwind, it's a brick in the wall of worry. So far, it hasn't proven scalable to overwhelm our economy.
Yeah, overwhelming our economy. The let's bring it to the last thing, and this was the you're very bullish on energy right now.
Okay, I'm all right. You're telling me I am.
I read somewhere. Let me.
Yeah, I mean, it's hard not to be, right?
Let me ask the question a little bit.
Okay.
Okay. 2 years ago or so, you were being paid $40 to own a barrel of oil. Mm-hmm. About that, it's when it went negative, right? Yeah. Now we're over 100 or so, right around 100 right now, down from 130s, I think. I can't recall.
I think we did hit 130.12 or something. Yeah.
Yeah, it's a pretty big move. Last time we saw that move was late 2000s. We got higher, so it is not unprecedented. A lot of people don't really remember that, or didn't even know that it, 165 maybe was it, or something like that. So much like me, when I'm, the NASDAQ is at 10,000 and then 11,000, then 12,000 and 13,000, I'm pretty bullish every time it goes higher. Bit of a pullback here on crude. How are you feeling on the future of that? Given a war, given COVID, given everything's already, $6 at the pump in California last week.
I definitely think if you asked me this 6 months ago, before Ukraine, Russia, I would have said low probability this persists. And we're likely going to see this arrested and back in the $40 range. But with all of the geopolitical issues and how slow it is for alternative energy to scale, produce and scale, and then get adopted, you have to be bullish on energy. You have to be, in my opinion, you have to be bullish on crude. You have to be bullish on energy. You have to be bullish on nat gas. So
I am.
I agree with it contextually, practically, right? Because that's what it all comes down to. If I'm an investor, how do I, best practice that? I'm not confident in your drillers. I'm not confident in your oil and natural gas exploration companies and things of that sort, because I've seen this movie play before.
Yeah.
And I posted, tweeted about this maybe 2-3 weeks ago. It's one thing for energy prices to rise. It's another thing for energy prices to trend higher. It's a whole other thing to buy stock in the individual energy related companies and or ETFs. Why? Issuance. They do this every supposed commodity, or the onset of a commodity boom cycle. They did this in 2006. They're doing it again. They issue so much supply, so much shares. It doesn't matter. Even so, if Devon Energy, just picking one out of thin air, Devon Energy issues, 50 million shares. Energy prices, the price of crude can stay $100 a barrel through all of next year. Can almost guarantee you their earnings per share are going to roll over. Right? There's too much overhead supply. If we look at the different sector ETFs and how many total shares are outstanding, the only sector that does this, and it happens every supposed boom cycle, is the energy sector. It's one of the reasons why it became, energy sector used to be, the second largest in the S&P 500, and then it just dwindled down. It became 2%, just 2% of the S&P 500 as of 2020. And now it's back to up almost 5%, because of the environment, because of this cycle. So I think you have to, be a good futures trader if that's the market for you. But when it comes to picking one of these stocks or even the ETF, you're going to run into disappointment, and you're going to say, but they're, drilling all this and they see all this revenue and everything. Why is the earnings per share going down? And then you go and look at how much issuance, they had particularly, and you look at just the entire sector. It's the highest, that it's been since 2010. So investors have to gobble that up. So you just don't get the appreciation you're looking for. On the flip side of that, what has been the only sector that has had nothing but lower and lower and lower share issuance, which speaks to the period of time that we're still in.
Sure.
Technology. Only sector that, and this is something my dad taught me, a long time ago. He said, Seth, you want to own something that's going to appreciate in value and have scarce demand in perpetuity. And that defines the technology sector. Every single year, the outstanding shares go lower and lower and lower. Why? Because it's the information technology era, and we're buying technology. And we're acquiring this firm and acquiring that asset. And, stocks are small, non-profitable tech companies are getting taken out left, right, front, and center. So, I'm bullish on the price of energy, even agricultural goods. Look at wheat, corn, oats. All of these prices. I think you got to be a good commodities trader. But, other than that, I guess you could have less risk doing it with ETFs. But if you're trying to be a stock picker in the energy sector, that's a lot of work. And you have to believe that this time really is the commodity super cycle and it has legs, because you're going to need more time. Regardless, you're going to need time to work off that outstanding shares, even if so you need this to be a super cycle.
Is it the issuance? Is it with the ESG movements out there? Is it still as ripe as it was 10 years ago, 12 years ago?
No, there's kind of been a stain over the last couple years, mostly since we've come out of the pandemic lockdowns, because it's kind of like health tech. Yeah, I mean, Teladoc is a prime. I mean, wow, but all the money that went into health tech and digital healthcare over the last 5-6 years, and we've heard all of these great things that are going to come from it. It's just a lot of money that just keeps getting poured. It's like, Silicon Valley, as it was known for that, it's still kind of known for it, but there's that whole arena of digital healthcare that has just been pumping money. It's coming. And, we're 5 years into it and, many billion dollars of investment, we can't find that game changer. And that's what I think ESG, that's the moment ESG is at. It's like, it sounds great. It looks great. It's going to be great. It's going to be great. Did I mention it's going to be great? And, people just get to a point where it's like, well, I'll divert some over here.
Yeah.
And so you do still have all of these IPOs and you still have all of these different firms trying to devise ETFs, right? In that space, but by and large, it's just not manifesting the way that people want it to. And so, yeah, you have people leaving it and then you're left with all of this overhead supply.
Yeah, well, that's it is absolutely an interesting thing when it's really easy to look at energy. And so as a futures trader, I will always look at taking the futures. If I'm going to, the leverage and the cleanliness of a future contract, like they're not jamming corporate scandals into a futures contract. They're not jamming, whatever it is, issuance.
You're not engineer energy or
or an earthquake happening in your, the corner of the Midwest that you have all your fracking going on or something like that. Like it's pretty pure. And then the only other time I would be looking to go underlying names is when I can get a high leverage play, some really low delta calls, let's say, on a name that that could do it. But at the same time, I'm probably going to get a fantastic rip, movement on the actual futures itself. And so, it's kind of funny when you take that top down approach in the commodities and then you start looking at it. It's like DBA, DBC, USO, like those sort of commodity tickers. Not only you're not trading a basket of commodities, really. You're trading companies that are doing the commodities a lot of the times. Maybe those aren't the right names for that, but it's always challenging. And I do recall a point in my life where ExxonMobil was the largest company in the world.
Yeah.
And,
we are definitely dating ourselves.
Nobody had love for Apple back then. It was
no. I mean, Apple's gone. People don't realize Apple's gone through 3 busts where it's down 30%.
Well, three. I mean, 80 was it the 80s that it IPO'd? Mid 80s, mid
85, 82 or 85, something
somewhere
like
around
that.
there. Yeah, I mean, it was a lot of people think a lot of people don't realize how old that company really is.
It's just amazing to see the transformation, because it was Coca-Cola back then. Everything was Coca-Cola, ExxonMobil, Hewlett Packard,
right?
Bigger than Apple. I mean, Xerox,
sure, car companies,
Westinghouse. Westinghouse. I mean,
Kodak.
I had to do a 5th grade project. That was my true first experience in the stock market, following Westinghouse.
Wow. That's
Yeah,
cool.
that was the junior is kind of like people say Canada is America Junior. Westinghouse was GE Junior, General Electric Junior.
GE. I mean, GE used to be the biggest company in the world too.
Started GE and Radio Shack, right?
But that's the thing about those businesses, right? They don't run at 20 and 30% profit margins.
Right. Yep.
And like Facebook, like Google, like Apple, I mean, like Facebook's
revenues for those. Yeah.
And consistent. Like, can you imagine just billions and billions and billions of dollars? Well, you can, because you're a tech investor, but billions and billions of dollars of every quarter, and you get dinged for dropping $1 billion or something like that. You lose
Amazon, right? That one didn't. Well, I tell you, I mean, opportunity rarely knocks twice with Amazon, let alone 3 times. But that's what one I've been fielding a lot of calls on recently. Seth, I mean, it got creamed. Like, did something really go bad, or is this one of those opportunities? And every call I'm like, as long as it's just a regular, part of your portfolio, nothing outlandish. Yeah, you rarely get discounts like this in Amazon. And I've seen this movie with Amazon before too.
Sure.
They take in costs. They're having to figure out their scale because they had all of this build out. And so they had a bad quarter. And what do? They just sandbag for the next one, setting that really low bar. And then lo and behold, of course, the next quarter they beat pretty substantially. But yeah, that's another one that was tough. And I guess you could say some of the writing might have been on the wall because they were just spending a lot. It was almost as if they said, for this quarter, we're still lapping all of those really strong comps, and we're just not going to be able to make it there with the economy, reopened pretty heavily, and the services, things are going more to services as opposed to goods. Let's just spend, get the employees that we want, give all the incentives, get our, our distribution hubs where we want there, our investment for delivery, and we'll just have a bad quarter and set the bar even lower. And, by the end of this year, I mean, the comps start to get really easy again for Amazon. And, a lot of folks don't look at it. I mean, you look at PayPal, some of these stocks just got bludgeoned. PayPal was $300 and now it's $100. And yet the company's still guiding to 16% revenue growth. And I'm like, there's either, this is a company that's going bankrupt, or this is a rate of change issue. And you can make the fundamental argument that absolutely, the COVID winners from 2020 are now the losers post-COVID. I mean, you've got a rate of change issue that there was no way these companies could continue on that pace, the laws of large numbers. So many opportunities in this market, for investors, if they, just have the right resources and stick with it. Just stick with it. It'll do you right with time.
Yeah, time is coincidentally, we've
yeah, I think we've extended our welcome.
No, I'm fine with that. I don't mind. The last point real quick is my son, we both have children, and my mom basically opened up a savings account for all her grandchildren and puts birthday money in there all the time.
Right.
And sisters, like, she's like, let's do a college fund. Sisters like, no, we don't need college, or any of that sort of stuff. And so, I'm looking at Fidelity. I'm like, what can I do? Like, what can I do for my son here? And when you invest for a 2-year-old, your time horizon, like if I'm over here investing, sometime I'm like, okay, I think Coinbase is going to continue to print money. They're going to keep, it's an exchange. Let's look at the CME, done pretty good through over time. This just happens to be in crypto, and okay, so it's cut in half since I probably bought it or whatever. And for myself, is I put those in the IRA and my own thinking. I'm kind of, it's I'm okay to think long term on that sort of stuff. I pretty much look at profit margins and I do a lot of fundamental. Like when I'm looking at long term investing, it's all fundamental because it's more of a venture.
That's where you get your confidence. Lines on charts sometimes don't give us confidence, but if we know why the lines are doing what they're doing.
Sure. And in Amazon, they always say, like, sometimes Jeff Bezos would be congratulated on an earnings call, and he's like, yeah, but he's really thinking of like his earnings next year, his Q1 next year of 2023. They're thinking about that. And what's great about that with a company like Amazon is you can bet on the fact that everybody's, they bought too much on this Amazon Go. They invested too many people, and Omicron came and went really quick, and now they're over leveraged and they're keeping all these people and all that sort of stuff. So that's okay. You're now casting your position on Amazon, which gives you, as you said, it gives you a nice discount. So I'm always looking at those at just how they're going to continue to allocate capital as a company. If that's the worst thing that they did was they invested in their staff and took yet another experiment that didn't go so well, and continue to not be worried about the fact that they take experiments that don't go well, except, Amazon Prime hits, AWS hits, let's leave books.
Whole Foods has been a disaster. Amazon Fire phone was a disaster. Yeah, exactly.
And it's just turning and turning, and it just keeps going. And so, I'm with you on
I'm doing crypto. Well, I took my first position recently in crypto for the portfolio.
Let's finish on that.
Let's go. I have not been my hesitancy, obstacle, self-imposed through, my own fundamental composition, right? I'm a fundamentals guy first. So I'm looking at the business model of anything, and I'm saying for this business model. And when it came to, we'll just blanket and say Bitcoin, just because it's easier for me, because I'm not a crypto expert by any means. But I've always had trouble, I've always had difficulty getting to that utility aspect of crypto, and then beyond utility to the scalable aspect of crypto, because I want to know what the tail is going to look like. So that's the headwind I've had for the last, 6-7 years, while I watched it go from the lower left-hand corner all the way up to the right, with volatility, of course. But again, volatility is the price we pay for those expected returns. And it got to a point where I said to myself, well, in some way, you have to respect price. You have to respect trend. And, in a certain aspect, you say, okay, well, how can I limit my risk while still respecting all these things from a disciplined standpoint? And it always comes back to position size. I said, if this is going to keep rising in value as an asset class, I want to participate. And when I get my foot in the door, it's also going to force me to get more involved. Sometimes we actually have to be in it to do it. I've often found, if you're in it, you're that much more vested. It becomes that much more real. You spend that much more time. So that's where I am. I bought my first crypto, position about 2 weeks ago in the portfolio. Minor position, nothing more than 1%. But that's where I generally start. So, my fundamental basis is, that's what I pretty much outlined. It's technical and fundamental. It's an asset that I, have to appreciate, is rising in value, rising in participation too. And that can be, in and of itself, a self-fulfilling prophecy. You get enough people involved, I've been listening to Warren Buffett and Charlie Munger, which I'm sure everybody has seen the denouncing of crypto for the better part of the weekend, and I get what they're saying, where I struggled with it too. Where's the utility? Where's the scalability and things of that nature? But I can't deny, let's look, you can't deny Tesla, right? I mean, where's the trending profitability? Where's the scale of units after some 10 years? Come on. So, but there's a religion there with Tesla. There's a faith. There's a trend. And things are getting, you can see it's slow. You might not appreciate how slow the scaling is going with Tesla, but everything is going in one direction. And so that's how I can kind of, listen to the Mungers and Buffetts of the world and Jamie Dimons of the world say it's garbage, it's toxic, it's this, it's that, and still justify participation in my portfolio.
Well, and it's credit to you. The broader crypto, the big caps are down at about 50%. So a lot of people don't come to that conclusion when it's down 50%. They come to that conclusion when it's up 120%, right? Where it's like, oh yeah, yeah, it's going to be 125 Bitcoin, 125,000 by Christmas. I guarantee it. And all that stuff. But there's actually here's a little piece of alpha for you, is to value a network, to value something like Ethereum. Well, both Bitcoin and Ethereum are, and Ethereum will be here. But an interesting one on Bitcoin is the actual number. It's like you can't issue. It's an issuance winner.
Right.
Like the problem with energy companies is there's unlimited. They can just dump on anybody, and with Bitcoin they can't. It can't be done. There's just 21 mathematical, 21 million mathematical. It's finite. It has enough. It's so much, $2 trillion market or something like that. That if you're willing to look at a $2 trillion stock, you might want to be looking at a $2 million or $2 trillion asset that you can actually own. One of the interesting things is Ethereum, because you're a fundamental guy, there's this thing called Token Terminal. If you want to check it out, tokenterminal.com. And you can do fundamental analysis, PE ratios, price to sales. And the most valuable revenue generating network by, I think it's hundreds of, or even millions times, is Ethereum. Generates billions of dollars a day, I think, in transaction fees. And they're doing a new flip into the merge to ETH2, where it'll be proof of stake. So there won't be actual machine mining, burning of electricity to do it. You just have to own 32 Ethereum tokens to have your own staking pool. And so that secures the network. And that provides, you have an ecosystem of consumers who want to use it for buying things. You have, Ethereum's kind of like buying, I'm not the first one to say this, but it's like buying, if you could have went out and bought stock on the internet in 1995 or 1997, gotcha. In hindsight, yeah, my mega long on Lycos was probably the wrong move, right? But if there was a way that you could, and that's kind of what like Ethereum is, but there's a really good fundamental way to break it down on that. And there's some cool stuff coming up on Ethereum that they're having some problems with. I don't want to get too nerdy on it. And then there's starting to be a lot more.
I know that.
Go ahead.
Oh no, I was saying I know that in the coming months I'm going to be that much more embedded in all of the nuances and fundamentals of crypto. I'll probably be at the next, if they're doing, I guess they do it in Miami every year, the crypto conference, the same way they used to do the retail conference in Miami at the Fontainebleau back in the day.
Oh, okay. Blue.
I'd like to go there. I'd like to, experience it and really, because networking is so big in crypto.
Sure.
I've come to find, and as I said, with equities, with equity research, having the resources. And at this stage, it's, I'm my solitary resource along with yourself. But I know the value, of opinions, facts, it's what they say, two heads are better than one. Right now, the majority of my head is guiding my whole, emotional quotient when it comes to watching, Bitcoin and Ethereum and Litecoin in their price movements intraday. It's just like, wow, you're down $800 on Bitcoin 5 minutes, and then it's up $1,800, and you're
comparatively pretty wild.
Yeah.
But yeah, those are simple moves that in crypto that pretty much nobody really pays attention to.
Right.
Well, I mean, traders, there's a massive amount of awesome opportunity, day trading and shorter term trading, that stuff, because everybody's so caught up in the, like the move from 38 to 150,000 or something like that,
Yeah.
So you can get in and squeeze your little things out, and that's a lot of fun with it. But if you wanted to put a value investor thing on crypto and just say, okay, let me see what this works, because there's a lot of utility in the crypto products out there, and when you start comparing them against, like, okay, does this thing make money? What value is this thing really doing? Is it just just that they're selling them and there's hype and there's no regulation and there's no limit to what
NFT, or is it something?
Yeah. And there's a lot of stuff you can see when venture capitalists, it's a much more interesting way for them to get liquidity, where typically they would invest in companies in 2022 expecting 90% attrition rate, but a handful of them in 2030, 2035 to go public, right? Well, now with the thing in crypto, they're getting liquid within, they put in the money, and then within a couple of weeks they're liquid at a 10x or 100x on their thing. Right. So that's a downside of a lot of what's going on right now, is that some of those things are just scams, in that way. It just happens because it's unregulated. And it's new, and there's people who don't know anything. So
where do you think, if I can interject a question, where do you think that stands so far as regulation, be it, SEC, or the Federal Reserve itself, and even, we've seen all of the legislation's coming, it's coming, but that's another aspect that we've been hearing, just a lot of rhetoric, but nothing has been concrete to date on the regulation front.
Yeah. So when I did my fund in 2017, it was a crypto fund. I had to register with CFTC.
Okay.
And that was just a judgment call, because you really, at the time, it was nobody knew. You were, generally speaking, you were a venture fund, pretty much, of illiquid. There was no regulated exchange. There still isn't really regulated exchange on that or anything like that. So it was just kind of like, okay, well, let's dot our I's, cross our T's. Let's go. Let's be aggressive on it. And the CFTC, our analysis is that that's who we wanted to be regulated by. So we were kind of going down that path. Right now, a lot of it has to do with politicians are really starting to get involved into it, and which SEC has been, they have their corner of it, and their real thing there is a crypto ETF, right? A spot crypto ETF as opposed to a notional. And whereas the CME has 2 contracts, Bitcoin and Ethereum, and 2 micro contracts, Bitcoin and Ethereum. But Bitcoin has been live since 2017, trading Bitcoins. Right. And so to me, they're the incumbent. They've got enough They've got a lot of experience there already. The CME, and of course CME falls under CFTC. And so I think that's probably where, and I think that's who wants it. But that doesn't mean anything, because obviously SEC is pretty heavy on that space too. So I think there should be good regulation, but I also know that there's this cool little thing about, you can own your own crypto. You don't have to trade on exchanges. You can get yourself your own wallet, paper wallet, do whatever you want. You can own it. So there's some interesting abstractions that are going to be challenging along that way. But I think, personally, I think that the CFTC is probably going to get to it eventually. Maybe that's something that can actually get accomplished in a
split parties. Yeah.
Split party. There you go. Yeah. Maybe that's something that could happen. Maybe it doesn't. My guess is if nothing's going on with crypto, then people are going to be very focused on every detail. They're going to, a lot of people are fighting in there. They will be like hawks on anything that happens in DC. If we're trading at 150,000 on Bitcoin, I can guarantee nobody's paying attention to what's going on with regulation, or less will be paying attention to what's going on in regulation, and they're going to be chasing it that way. So maybe that's a way to think about it. I might be wrong, but certainly if you're managing client money, you want regulation. You want make them feel happy and safe. I guess I should. That was one of our big issues back in 2017 was custody, and just getting all that. They solved that. Obviously that's been solved now, but that was a big issue back then.
One step at a time. It's coming.
Yeah, if they can regulate it, they'll regulate.
I appreciate it.
Yeah, it was a good chat. Let's wrap here. Finomgroup.com, FINOM.com. Get signed up. You want so you've got 3 weeks, every 3 weeks, each 3 weeks.
We do a weekly research report for 3 weeks in a row, and then God feels that I need a break, so I get the 4th week off. We do a weekly state of the market video analysis every week. And we have third-party research that we disseminate at times also. But yeah, our weekly research report comes out Sunday, and it's you get your technicals, you get your breadth, you get your quantitative analysis, you get your update on the earnings outlook, political, if there's any of that stuff. Full, I call it a macro market report, because it's everything from the whole macro, everything outside of the market and everything going on inside the market. I've been doing that since 2011, my first firm, and it's laborious. I mean, people will tell you just reading it is laborious, but that's what I'm used to on the institutional side, and it just became part of me. It makes me feel comfortable, and it gives me an edge, and our members feel like no matter what, on a weekly basis, they're not overwhelmed by price action. And as I said before, it's all about your stomach. If you can keep your stomach fine and just ride the waves in the market, you're going to do well. And sometimes we just need that macro market research report that we deliver to kind of bring the investor back to center. They're getting all the information, and they're getting that long-term vision in there with the disciplines scattered throughout the report. So
good. Well,
thank you.
You gave us some insight. I'll tell you what, guys, these 2 hours that Seth and I spent chatting, throwing him these shots every few minutes, changing it up. That's pretty much what it's like reading their weekly macro research report. You get everything. You get it all. It's in depth. I highly recommend it.
You got to come on my show one day, Chris.
Of course. Yeah, I'd love to. We'll do this weekly.
Good stuff. Good stuff.
Also, you can catch him on Twitter. He's always posting some good stuff it's at Seth CL.
At Seth CL. Yeah, our first firm was Capital Ladders at Seth CL,
All
capital
right.
L. Yeah.
Yeah, Seth
Never
CL on.
changed it. I never changed
Yeah.
it.
Yeah, well, it works. So you can get his quick insights there. He does share a lot of his stuff there too.
Yep.
Some quick hits that are extrapolated from the report, and just the amount of data that he consumes on a weekly basis. Definitely give him a follow, and we'll have you back soon. It was a pleasure as always, Seth. Anything else you want to share with the
No,
folks?
this was great. I totally appreciate the time and the platform, Chris. I got to get you on my program, on my YouTube channel next.
Sure.
We'll get that scheduled possibly for next week. But
works.
to your audience and to your members, I mean, I know you do them a great service as well. I've known you for now a couple of years. I've known you when you were with Macro Ops as well. I mean, that's kind of how I came into your person, is through Macro Ops and your work that you did there. So it's great to have these relationships with people thousands of miles away who are just have the same kind of passion for you. So, and I appreciate your service in the military and what you're doing for investors week in and week out. So God bless, brother.
Likewise, sir. All right.
Take care.
Take care.